You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way. It's the 10th of August 2025 with me, Sam Ball, and my co-host John McEwen. On this week's episode, we'll be discussing Games Workshop, Unilever, Haleon, Taylor Wimpey, Greggs, and our US company of the week is Visa. John, should I start us off with a favourite of the show, Games Workshop?
Yeah, no, absolutely. How are they doing?
They are doing excellently. It's also one I'm a shareholder of, but you've never quite pulled the trigger on, which I'm sure we'll get to when we get to your comments. But they have come out with their full year results, and revenue is up 17.5% to 617.5 million. And of that, core revenue was up 14% to 565 million, and licensing revenue was up 69.4% to 52.5 million. And the revenue at constant currency was up 19.5%. The core operating profit at constant currency was up 26.1% to 220.5 million. And the licensing operating profit at constant currency was up 91.9% to 51.8 million. The operating profit was up 29.5% to 261.3 million. And the net increase in cash before dividends were paid was up 26.7% to 197.5 million. The earnings per share were up 29.7% to 594.9p a share. And the dividends per share were up 23.8% to 520p a share. In terms of the business model, which we have covered before, but there's a few comments in that section which I quite like to cover. We are an international business centrally run from our HQ in Nottingham, with 79% of our core sales coming from outside the UK. We have our two main factories, a paint factory, two warehouse facilities, the Warhammer studio, and back office support functions. All are based in or near Nottingham. We design all our products at our HQ in Nottingham. Our product is distributed from our East Midlands Gateway warehouse, approximately 25 minutes away from our HQ. EMG supplies our two hubs, one in Memphis, Tennessee, and one in Sydney, Australia. Between these three warehouses, along with small third-party operated warehouses in China and Japan, we are able to directly supply our independent retailers, our own retail stores, and fulfill our online orders. Our stores only stock Games Workshop products. They're where we recruit the majority of our new customers. To do so, the stores don't offer the full range of our product, only starter sets, new release products, and the appropriate extended range. At the period end, we had 570 of our own retail stores in 24 countries. We have 424 low-cost stores, small sites, each one operated by only one store manager. We also have 146 multi-staff stores, which, like our low-cost stores, are constantly reviewed to ensure they remain profitable. If not, they will probably be closed. The bulk of our sales to independent retailers are made via our telesales team based in Memphis, Nottingham, and Barcelona. We also have small telesales teams in Sydney, Tokyo, Shanghai, Singapore, Hong Kong, and Kuala Lumpur. In 24-25, we had 8,100 independent retailers, up from 7,200 a year ago in 71 countries. Those independent retailers have gone up quite nicely as well, actually. It's worth noting our licensing performance will be very difficult to match next year. Space Marine 2 performed well above our expectations. We will, of course, be focusing on more Warhammer 40,000 games and at the same time continuing to look for partners to bring our Age of Sigmar IP setting and characters to console, PC and mobile. Our current estimate is that if we did nothing, new tariffs could impact profit before tax by about 12 million next year. We already have a US corporate entity and we are investing in our base in Memphis and opening new stores across most states. Tariff costs are likely to reduce our reported gross profit margin next year. We have a detailed operational plan to make up the approximately 2% gross margin shortfall through efficiencies. This is not a simple task when we're already very efficient, and it may take longer than 1 year. In terms of the split, the trade revenue makes up 61% of core revenue, and that was up from 58% a year ago. The retail revenue makes up 23%, and that was down from 24% a year ago. And the online makes up 16%, and that was down from 18% a year ago. In terms of the store openings and closures, in the UK, the number of stores remained flat. In North America, 18 stores were opened and 2 were closed, and the number of stores at 1 June was 201, which is up from 185 a year ago. And also, they've got more stores now in North America than they do in any other region, albeit the UK and continental Europe are split out as separate geographies. Continental Europe, they opened 8 stores and closed 3, and that leaves them at 167. Australia and New Zealand, they closed 1 store, and that leaves them at 48. And Asia, they opened 2 stores and didn't close any, and that leaves them at 20 stores. So in total, they have 570 stores, of which 201 are now in North America. Of those 570 stores, 424 of them are single staff stores. They've said retail sales in North America are up 14.6% to record levels at 51.7 million. And in the UK, retail is up 7.9% to record levels at 37 million. So North America is already quite a bit of a bigger market than the UK, and it feels like that's still just getting going. In terms of the valuation, they've had a very good year. So over 1 year, the shares are up 55.7%. However, the results are excellent, but the business now trades at a PE ratio of 29 and has a dividend yield of 2.7%. As a shareholder, I think these results are excellent. It's not a cheap business, but I think with these kind of results, and it kind of delivers these results quite consistently, I'm quite happy to hold it. I think you could make an argument for topping it up, really, given, I know the IP is probably going to drop next year because they had Space Marine 2 was so successful, but obviously you've got the Amazon stuff, and I think that IP revenue will continue to go up. I really, really like it, and I think, at 28, 29 times earnings, I think obviously it's a fantastic, fantastic business, but when you consider that you could buy Rightmove for the same price and not get anywhere near the amount of growth that you're getting from Games Workshop, I actually think 29 times earnings, I think it's not cheap, but you can make a pretty decent argument for it. John, as someone who's never bought shares but has been tempted.
I think fantastic. I'm very, remorseful about it, and of course anchored to the price that I know that you bought shares at, but it has gone on over the last few years since covering it, and it's done fantastically well. I think you're seeing, particularly with the licensing, and I think you've referred to it as sort of Disney in an obviously much smaller entity, and it has that sort of quality to it. So yeah, I guess it's the valuation currently and sort of the fact that I am anchored to what it has been, but you certainly can't knock how it's doing. Really, really quality.
Is there anything then that would trigger you to take a closer look at it other than the valuation coming down?
That is the main thing, and it's coming, overcoming that.
Is it that you think it's expensive at 29, or is it just pure anchoring?
I think it's a bit of both.
Right.
I think it's a bit of both.
Okay. Should we move on to a business that you do own?
Yes, and it's doing much less well. It is a bit cheaper, but yeah, Unilever. So it's the owner of multiple brands: Dove, Domestos, Hellmann's Mayonnaise, Ben & Jerry's, Walls. It's got a huge number of top quality household brands in its portfolio, and it's the UK's largest consumer goods company. They had their half-year results out with first half revenue of €30.1 billion, reflecting underlying sales growth of 3.4%. All business units contributed positively, with ice cream growing the fastest at 5.9%. Underlying operating profits declined 4.8% to €5.8 billion, and that was largely due to a step up in the advertising spending. Free cash flow halved to €1.1 billion, reflecting lower profits. The ice cream demerger costs and a planned build-up of inventory amidst the tariff uncertainty accounts for that, and net debt rose from €25.2 billion to €26.4 billion. The ice cream demerger and separate listing is expected to complete by mid-November this year, and Unilever will retain a stake of less than 20% in the business for up to 5 years. Full-year guidance was maintained, with underlying sales growth of between 3 and 5% expected. Quarterly dividend of 45 cents a share was announced, and the shares were broadly flat in early trading. In terms of valuation, Unilever has a market cap of £110 billion and trades at 17 times forward earnings, compared with a 10-year average of 19, and has a prospective dividend yield of 3.7%. I thought these results were fair. it's difficult to get excited about them. I think if you, like us, have been following for the last few years, these are better, certainly, than when things were stagnating a few years ago. And it looks like they are taking action. I mean, ironically, the ice cream business that they're spinning off is what contributed the most positively. But I would back the new chief executive, Fernandez, to bring Unilever back to the higher single or mid to higher single digits growth. And when you look at those brands, Dove, Domestos, Persil, Shaw, with increased brand and marketing spend, which is now over 15.5% of revenue, which is the highest in a decade, I think they definitely can do that. However, currently, just on those results, if you looked at a snapshot, I think a bit disappointing, but it's more of the trajectory and getting Unilever back to what it can be. And I suppose the exciting thing about all of the consumer goods companies is more down to the growth in the emerging markets and that driving the businesses forward alongside having stable and steady growth in the more mature Western markets. But we will wait and see. I'm happy still holding my Unilever shares.
I would be inclined to agree. So I think at a forward P of 16.9 and a yield of 3.7%, I think that's pretty reasonable. I don't agree with spinning out the ice cream business. I understand that it's lower margin than the other power brands, but when you go through those ice cream brands, it's like they've basically got the UK ice cream market kind of locked up. There's some really fantastic brands in there, and I think they're best under the Unilever umbrella. That being said, obviously, if you're a shareholder now, you get both of them anyway. But I do wonder if it's partly a way of maybe getting rid of some of the debt as well. They do tend to spin these businesses out with more than their fair share of debt, as we saw with Haleon, which we'll cover later in the show.
Yeah.
But yeah, I just, the results aren't great, but equally, I think this is the first half since Fernandez stepped up to CEO.
Yeah.
And he's stepped up the marketing spend considerably. So there is a strategy in place, and I think he needs a bit of time. And obviously, as we've covered previously, Terry Smith in his AGM, he was very, very positive on Fernandez. So yeah, I not a great half, but given that it's his first one and he's ramping up the marketing, and they've also got the distraction of the ice cream business, which will be gone the next time we cover this business.
Yeah.
I think you've got to give him a bit of a pass, really.
Yeah, no, absolutely. Personally, I'll still be holding on to the ice cream business.
Shall we move on to a business that Unilever tried to buy?
Yes. For how much, Sam?
50 billion. So,
Yeah.
see how much it's trading at now. So they could have themselves a bargain. That's 32 now. So
that's after considerable growth.
Yeah. So Haleon, which was like the consumer goods division of Glaxo, which has been spun out. It's Glaxo, wasn't it? That's where it came
it's
from.
Glaxo.
Yeah, which has been spun out a couple of years ago. They have reported their half-year results, and they've got some pretty good brands. So they've got Sensodyne, Aquafresh, Panadol, Tums. They've got lots of others, but I've just given like sort of the main ones that I recognise. So they have come out with their half-year results, and second half underlying revenue grew by 3.2% to 5.5 billion, and that was below the 3.4% that was expected, with price increases contributing to most of the growth. Underlying operating profit for the first half was up 10% to 1.2 billion, driven by strong pricing and efficiency gains without pulling back on brand investment. Underlying free cash flow was up 184 million to 734 million. Net debt came in at 7.7 billion. The interim dividend was raised 10% to 2.2p per share. Over the period, the group deployed around 370 million of its 500 million share buyback. Full-year underlying revenue guidance has been downgraded from 4 to 6% to around 3.5%. Underlying operating profit growth is expected to land in the high single digits for the year. The shares were down 4.4% in early trading, and there's been weakening demand in the US. However, outside of the US, the growth has been okay, and that includes mid-single digit growth in China, which is following the recent move to take full ownership of the Chinese distributor of non-prescription medicines. The direct risk of tariffs are pretty low because there's a lot of local production in the US and limited sourcing through China. And there's been a strong focus to improve cash generation and get net debt down to a target of 2.5x underlying cash profits. So for reference, they are currently at 2.8x, so not a million miles off. And they have done pretty well with the business since they took it over in terms of getting that debt down. In terms of valuation, business trades at a forward P of 18.9, and that compares to that compares to an average since listing of 17.8. And the prospective yield for the next 12 months is 2% compared to an average since listing of 1.9%. You do obviously have to factor in the buyback as well. So what's that? 500 million on a 31 billion market cap. So that's like another 1.5%. So if you factor that in, it's probably like a 3.5% yield, so not dissimilar to Unilever. But my issue with it, I think management have done a really, really good job since they were spun out of Glaxo. I think they've done a really good job paying down what was probably an unfair share of the Glaxo debt pile, but they've done a good job paying it down. They've done a really good job getting efficiencies out of the business. So, there's been a lot of cost cutting. We haven't really seen much of an impact on the revenue. So it does seem like there was quite a lot of bloat when they were spun out, which is maybe part of the reason for it, because it's allowed management to actually focus on the business more. But yeah, done a really, really good cutting costs and getting the operating profit up. But I just think at 19 times forward earnings, I'd rather have Unilever at 17. And I think Unilever as well, it's still very much a sleeping giant. I think there's a lot Fernandez can do with it. So I think for me, Haleon, it's a good business. They've got some good brands and they're doing a good job. But I think Unilever have better brands, and I think there's still quite a lot of potential to be unlocked in Unilever. So of the two, I think Haleon would always need to be considerably cheaper before I considered it over Unilever, and I definitely wouldn't pay more for it. What about you, John?
No, I couldn't agree with you more. And I think it's interesting to see what Unilever did offer, and I think, thank goodness, they didn't actually get it.
Yeah, it's
lucky escape there.
What's the operating profit? It's 1.2 billion for the half. So I know I'm being crude here, but if you just double it and say they could have got, because I don't see how Unilever, I know there would have been synergies and stuff. I don't see how they could have been more efficient than Haleon have already been.
Yeah.
So maybe assume 2.5 billion. Well, they might have bought it without the debt, in fairness, so it could have been a bit higher. But even still, you're talking like 25 times earnings for some of these businesses, which they just, like, they're decent, but it just would have been an overpayment. And I think that's pretty obvious now.
Yeah.
As it was obvious at the time.
No, absolutely. Okay, shall we move on to Taylor Wimpey?
Yes, how are they doing?
So, first half results out last week, and revenue was up 9% to £1.7 billion. And that was driven by new home completions rising 11% to 5,264, which was partly offset by a 1.3% decline in average selling prices to £313,000. Overall profit declined by 11.7% to £161 million, largely due to an unexpected £20 million charge to rectify substandard work by a subcontractor. Free cash flow fell from an inflow of £30 million to an outflow of £65 million, largely due to increases in inventories. Net cash fell from 565 to 327 million pounds. An average private sales rates have slowed from 0.64 to 0.59 in the 4 weeks since the half year end. Full year operating profit guidance has been lowered by £20 million to £424 million, and that reflected the unexpected charge. Net cash is expected to be around £350 million at the year end. And an interim dividend of 4.67 pence per share was announced, down from 4.8 pence last year. And the shares were down nearly 6% in early trading. In terms of valuation, Taylor Wimpey has a market cap of 3.6 billion and it trades at 0.87 forward price to book, compared with the 10-year average of 1.44, with a prospective dividend yield of 8.9%. I thought these results overall were pretty good. I think certainly when you compared it with Barrett Redrow, they were certainly quite a bit better than them. They do operate in a slightly different part of the market, more towards the lower end. They have one of the strongest land banks and balance sheets of all the house builders. Interestingly, their dividend policy is linked to asset value rather than earnings, so it's actually considerably higher than some of the other house builders, particularly when there's been this downturn and build cost inflation. Disappointing with the £20 million charge relating to poor workmanship, And you also do wonder how much more of that is left and whether that is, bearing down on the price slightly too. I think there are lots of tailwinds though, and with the easing of interest rates and planning laws potentially being more relaxed, they would all be good things for Taylor Wimpey. And it certainly, as with all the house builders, doesn't look expensive. I think it probably is one of the best ones available. I've owned it in the past. I wouldn't be opposed to owning it again, but currently I do have Barratt Redrow. And I think it always comes down to some of the fundamentals. You've got huge population growth in the UK. You've got an undersupply of houses. There's that structural imbalance. And you think that the solution to that has got to be these big house builders, and Taylor Wimpey being one of the biggest. So I think there's a lot going for it, even if there are some short-term headwinds. But hopefully, those tailwinds will carry Taylor Wimpey through the next few years.
I pretty much agree. I think maybe some of the figures are a bit disappointing, but when you consider sort of what's going on in terms of the wider economy, I don't think there's anything that's that surprising. I think the valuation seems reasonable and the yield's very attractive. Yeah, so Barratt did a profit warning. Completions down. I think we didn't cover these anyway, but completions were down. Profits took a much bigger hit due to safety charges. I can't say they gave a revenue figure, but I know that average weekly's come down in the next 4 weeks, but I would agree longer term there is still an undersupply of housing. So we were told we'd get 1.5 million new homes over the next 5 years from 2024, and we are well below target. So that probably bodes well for the house builders, because you think one of the things they might do is try and, you'd think they try and make it easier to build homes because they want to hit their own target. So yeah, I think long term, I think I still like it a lot.
Okay then, shall we move on to Greggs?
Yes. So Greggs, they have come out with their first half results, and first half revenues rose 7% to 1 billion, with growth being helped by new store openings. Like-for-like sales in company-managed shops rose at a slower pace of 2.6%. Operating profit fell by 7.1% to 70 million. Performance was held back by costs associated with building 2 new national distribution centres, shop refurbishments being first half weighted and mid-single digit cost inflation. Free cash flow fell from an inflow of 57 million to an outflow of 41 million due to the increased capital expenditure. Net debt was at 3 million at the period end, down from a net cash position of 125 million at the beginning of the year. The full year outlook remains unchanged, with operating profits expected to be modestly below 2024's level of 195 million and cost inflation expected to run at around 6%. A dividend of 19p a share was announced in line with last year, and the shares fell 1.5% following the announcement. They have blamed soft consumer footfall and sales on unfavourable weather, which I never like when they blame the weather. They never credit the weather. In terms of valuation, they now trade at a forward P of 12.6, and that compares to a 10-year average of 22.7, and the prospective yield is at 2.6% compared to a 10-year average of 4%. I think at 12.6 forward PE, I think it is cheap. However, I've seen a couple of people on Twitter actually, sort of more growthy investors that I follow, and there's a couple of them where they've opened positions in Greggs recently, and I don't really get it. I think they're maybe backing on it to maybe return to the growth it's been putting up. But I think we followed this business for a few years now. They've been very clear about their target of 3,000 stores. It looks like they're going to hit it. It's starting to slow down a bit now as they get towards that target. They've been opening the stores later. They're now at the point where I think about half of the stores are open late, but then there will be certain stores where they're just not suitable for late openings because they just won't get any footfall. Yeah, so they've probably maximize that. There might be a few more they can do, but it's diminishing returns with that, and you get to a point where they're already all open late. I just think the 3,000 stores, they are starting to feel, for me, I think quite saturated. I've always felt like they're quite saturated, but I'm in the north where there's a Greggs on, you can't cross the road without seeing one. You've commented previously, John, that in the south you are starting to now see more of them, and I think they've approached that 3,000. I think they're going to hit it, but where do they go next? Maybe they'll get to 4,000, but I think it's pretty saturated. I don't see how they do that without cannibalizing the existing stores. Maybe they could open a new product range, but I think when you sort of think about what Greggs is, there's nothing screamingly obvious for them to introduce. So I just don't see where the growth comes from here on out. And I think if you're buying it, that's fine. At 12.6 times earnings, you could do very well on it. But I think you need to accept that this is probably in transition from a growthy stock to more of a value stock. That doesn't mean you can't do very well on it. But I think going forward, it's going to be a business that's cheaper. So if you're looking at it thinking it's going to get back to that 10-year average of 23, it might never do that, because I don't know if it's ever going to put up those kind of growth figures again. And that doesn't mean it's not a good business or a good investment, but I think the type of investment it is in the time we've covered it is now starting to change. It's not for me. I think at just under 13 times earnings, I'd actually, maybe I'm being greedy, whatever you pardon the pun actually, there is a price at which I would maybe have Greggs in the portfolio. Yeah, I think for me, it would probably need to be a bit cheaper than 12.6, but I could see why someone could make an argument for it, because it's still an excellent business, putting up pretty good figures, and it may continue to do so for a while, but I think that growth is going to continue to slow. What about you, John?
Yeah, I'd feel similarly. When we covered it in the early years of the show, I think that was, I know it's easy when you're looking back, but I think that was probably the time to buy, and it was very much in the growth phase then. And when I was saying to you, no, Sam, it's not, saturated down here, which was true, now I feel like it kind of is reaching that point, and therefore you're seeing it in the valuation. Things are slowing down. I don't think it's ever going to get back to the sorts of multiples that it was when it was in the growth phase. So I think you could buy it with kind of accepting that, and it's a decent business, and they may just return more cash to you as a shareholder. But in terms of what the valuation, the share price does, very, very difficult to know. But I think it's a different business fundamentally from when we covered it on the show originally. So not one for me, in short.
It's quite interesting, though, because I think when we first covered it, we were obviously quite dismissive of it because of the lockdown and the high streets being closed. And very, very negative. And then we went, it started delivering these fantastic numbers, and it bounced back a lot more than I think either of us anticipated. And then we were looking at it and thinking, well, we've probably missed the boat a bit now, but if we'd been a bit more astute in COVID, maybe we should have bought it because it was a good business. But if you actually look at our share price, it's now basically back really to where it was when we first started covering it.
Yeah.
But I think the is maybe, again, didn't expect it to decelerate so much. Now, it might be that they get back to some growth. And if they do, that share price has quite a long way to go back up. But yeah, I think for me, I think there's too much of a risk that the growth days are now over. So I'd probably I think is there a price at which you would buy it in terms of the earnings? Because it's not a bad business.
Yeah.
I just think at 13, I'd be buying it with the assumption of no growth. And then there's not a very good yield either. That'd be my issue. Yeah. It came down to around 10, say, with a 4% yield.
Yeah, I think that is probably it would be that kind of price, but I doubt it.
It's not a million miles away.
It's not.
I think the issue is you've got so many maybe former growth investors that will just buy it and hope it starts putting, and it might start putting the figures up. But shall we move on then to our US company of the week?
Yeah, and the biggest by far. So Visa doesn't really need any introduction. They had their Q3 results out last week, with net revenue rising 14% in the third quarter to $10.2 billion, beating analyst expectations. An 8% rise in payment volumes and 12% increase in cross-border payments reflected resilient consumer spending. Underlying net profit was up 19% to $5.8 billion, supported by cost growth coming in a little slower than revenue and a lower tax rate. Free cash flow improved from $12.3 billion to $15.7 billion over the first three quarters, with net debt at $16 billion. Full-year guidance remains unchanged, with low double-digit net revenue growth, and the consensus was 10%, and low teens earnings per share growth, and consensus was at 13%. The company repurchased $4.8 billion of shares in the period, and a quarterly dividend of 59 cents a share was announced. The shares were down around 2.5% in after-hours trading. In terms of valuation, Visa has a market cap of $654 billion and trades at 28 times forward earnings, which is broadly in line with its 10-year average, and it has a prospective dividend yield of 0.7%. I thought these were very good results. It's an incredibly high quality business with growth ahead in emerging markets, but pretty mature in the conventional Western markets. And the risk, I suppose, is always with this business that if there were some sort of paradigm shift in a startup or crypto, I mean, very unlikely at present, then that could really hit Visa. But I think when you look at the scale of Visa, MasterCard, and obviously to a lesser degree, American Express, it's difficult to see something like that happening. I think I was probably more aware of something like that back in sort of 2016, 2017, when you had that first huge sort of crypto rally, and those sorts of things with the blockchain were being mooted. That now looks much, much less likely. And it's amazing, I think, that you can have a business of this size and net revenue rising 14%. I mean, it's huge, huge figures. With that quality, I think, comes that valuation, which is pretty high, but you're not going to get this business very cheaply. And I think over the last few years, it has shown its resilience and that quality has shone through. So it's not one for me. I'm sure in my indexes, I probably got a percent or something in Visa, but as an individual investor, I probably wouldn't be brave enough to pay, or I suppose paying up for that. Sam, what are your thoughts on Visa, MasterCard, American Express?
Yeah, I think these results are just incredible, really. I don't really understand how they've been able to increase revenue that much. I mean, increased 8% rise in payment volumes. I suppose they get a boost in that their business is basically inflation proof in the sense that you go out and spend the same amount, and if the price has gone up, their percentage take goes up with it, so they don't need to do anything. But it just seems like people must be using it more, and I don't really get how, because everyone seems to use it all the time already. But they keep putting up these numbers, and it just continues to baffle me. I think 28 times forward earnings, if they can keep putting up numbers like that, it's not terrible. But the main issue is when it's already so big, I don't know if they can or not. I find it really hard to gauge. Whereas if you compare that, for example, to Games Workshop at sort of 20 similar price, it's like, well, you look at Games Workshop, it's tiny compared to maybe what it could be. Whereas Visa, it's already massive. And yes, we can keep putting up the numbers, it's probably reasonably priced, but I just struggle. I've been saying it for 5 years on this podcast now and continue to be proven wrong. But with these massive American businesses, I just struggle to see how much bigger they can get. But yeah, I always struggle to comprehend them. It's really, really incredible what they're able to do. It's a great business. I'd love to own it, but I just wouldn't be comfortable paying 28 times earnings for it.
Fair enough. So of the companies this week, Sam, what would be your top pick and what would come last?
I think the top pick, I am biased because I own it, but I would have to go Games Workshop. I think the results are outstanding. I think it's a great business. I think there's so much potential for continued expansion in the US. You've obviously got, I know it's going to take a dip next year, but you've got the licensing revenue as well and the Amazon deal. I think there's so much to get excited about with it. And I think it's still, in terms of market cap, not massive. So probably Games Workshop. Least favourite, I think it's quite tough this week. I wouldn't say there's any bad companies in here. I'd probably go with Greggs, actually. And I think that's purely just because it's in that transition, I think, between growth and value. But I don't think the valuation's quite at the level at which I'd consider it as a value investment or an income investment. What about you?
No, fair enough. I would probably, and own bias is clearly coming through here, probably go for Unilever as my first pick, because I feel that's in the transition to getting back to growth, and it's a fair valuation at the moment. In terms of the last, yeah, I think probably Greggs, whereas I feel that's going kind of more the other way, and we haven't seen where it's kind of going to settle, and that would be why. If I were to look at these businesses purely on the quality, I'd say, Visa without a doubt, but it comes with that pretty toppy valuation.
Yeah, I think in fairness, there's 6 quality businesses this week. So even with Greggs, we're just picking on it because of valuation. The company's doing fine, I think.
Yeah, no, absolutely. Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.